Welcome to Talk Tickers, your focused analysis of the most critical financial calls shaping the market. Today, we're doing a deep dive into General Dynamics, specifically their Q3 2025 results. This call, well, it had a really significant beat and some definite momentum on the commercial side especially, but there's still quite a bit of nuance around the defense segments, wouldn't you say? Some friction points there.
Oh, absolutely. That's exactly right. The headline numbers look great, but our mission here is to, get beyond that. We need to unpack those big financial figures, definitely dissect the performance across the different segments because they were really divergent. Aerospace just exploded. And then we need to analyze what management actually said about the key defense programs, the supply chain stuff that keeps cropping up, and those macro risks, like the shutdown threat that just won't go away.
Okay, right. Let's start with those hard numbers then, because like you said, they were undeniably strong.
Yeah.
GAAP diluted EPS came in at $3.88. That pretty easily cleared the consensus estimates on the street. And revenue hit $12.91 billion.
Yeah.
Also beat expectations. And that's up, 10.6% year over year?
Yeah, it's a solid chart.
Operating earnings grew to 12.7% year over year, landing at $1.3 billion. So, yeah, a classic top and bottom line beat.
The earnings growth was definitely strong, no doubt. But for a company like GD, so capital intensive, I'd argue the cash metrics were, the real story here.
Okay.
Operating cash flow was reported at $2.1 billion. Now, get this, it converted at 199% of net income.
Wow, 199%, that's huge.
It's almost unheard of, really. It basically means nearly double the reported profit for the quarter actually turned into cold, hard cash in their pocket.
Okay.
And the free cash flow followed suit, $1.9 billion for the quarter. That kind of number gives them massive financial flexibility.
And they certainly need that flexibility, it seems, because the demand signals look, overwhelming. Orders hit $19.3 billion.
Yeah, impressive number.
So when you stack that demand against what they actually delivered, you get a company-wide book-to-bill ratio of 1.5 times.
Right. And anything over 1.0 means orders are coming in faster than they can fill them. That's a good problem to have, usually.
Usually, yeah.
And all that relentless order momentum pushed the total backlog to a new record. $109.9 billion. That's up 19% from last year.
$109.9 billion.
And that's just the firm backlog. If you add in the potential value from those IDIQ contracts, the indefinite delivery ones, the total estimated contract value jumps way up to $167.7 billion.
Wow.
That represents years of guaranteed revenue visibility, something highly, highly prized, especially in the defense world.
Management's tone seemed pretty positive, too. Their initial takeaway, they explicitly said Q3 was even better than their already strong Q2.
They did.
And they pointed to the operating margin improving 30 basis points just from Q2, hitting 10.3% overall. I think that sequential improvement, plus that almost 200% cash conversion you mentioned, that really fueled the positive market reaction we saw right after the call.
Yeah.
The execution just looked incredibly clean this quarter.
It did look clean, yes, but it wasn't uniform across the board. And this is where the story gets structurally quite interesting. The different parts of the business didn't contribute equally at all. We really have to start with the cash engine this quarter, Aerospace. Driven by Gulfstream.
Right. That segment was just a powerhouse. Aerospace revenue grew, a dramatic 30.3% year over year?
30.3%. And operating earnings surged 41%.
41%. And critically, the operating margin expanded too by 100 basis points, landed at 13.3%. That's a margin story driven purely by scale and, I guess, the new product mix, right?
Exactly. Scale means delivering more planes. They hit 39 aircraft delivered in Q3. That's a big jump from 28 the year before. And that included 13 of the new G700s. Management also made a point of highlighting a successful product transition here. They noted this was the first quarter without any deliveries of the high-margin G650 ER. And yet the segment still improved its overall margins. That really speaks to how efficiently they're ramping up the new programs.
Okay, I hear the margin expansion. That's impressive. But wasn't the G650 ER just phased out? I mean, that plane was a known cash cow for years.
It absolutely was.
So how worried should we be that they've essentially swapped out proven high-margin revenue for a new ramp-up that, inevitably carries some delivery and execution risk? Is that 13.3% margin really sustainable going into Q4?
That is exactly the right question to ask, but based on their Q3 execution, it suggests they have pretty high confidence. That margin resilience you mentioned was supported by introducing the next new plane, the G800. They actually reported 3 initial deliveries of the G800 in Q3.
Okay.
And that plane, the G800, it's a very high-end aircraft, and it's expected to provide most of the delivery growth in the fourth quarter. So that helps fill the G650 gap.
Got it.
Plus, demand looks strong. Unit orders are up 56% so far this year, mostly driven by North America. Management seems to view the G700 as kind of a market expander, bringing new customers into the fold. While the G800 is designed to just seamlessly step in as the replacement for the G650 at the top end, seems like they manage that transition quite cleanly, which, as you know, is often difficult.
Okay. So aerospace is flying high, generating exceptional cash. But the real test, I suppose, is whether that cash influx is enough to help smooth out those friction points on the defense side, specifically marine systems, right?
That's the perfect transition, yeah. Let's shift gears to the defense industrial base. Marine systems that's anchored by those huge shipbuilding contracts saw revenue up 13.8%. And that growth was driven by increased throughput on the Virginia-class and Columbia-class submarine programs. Basically, they're getting the hulls built faster.
They're making progress, sure, but the challenge that keeps coming up is that low margin. It seems stuck, hovering stubbornly around 7%. Management was really focused on this on the call. They called margin improvement in marine their most meaningful opportunity going forward. Why is that margin so depressed compared to the rest of GD?
Yeah, it's a classic execution puzzle. It really ties back to the supply chain and, to some extent, labor challenges on these incredibly complex multi-year programs. That 7% margin is low primarily because they're still battling daily issues with material flow. They need what they call sequence-critical material. Basically, the really complex parts needed at very specific points in the construction to arrive exactly on schedule.
Right.
If it doesn't, you potentially have thousands of highly skilled, very expensive workers standing idle, which just bloats the costs and kills the margin.
What's fascinating, though, is the sheer effort they seem to be putting into fixing it based on the call details. It's not just, throwing money around.
Yeah.
They talked about foundational investments.
Exactly.
Significant CapEx,
Yeah.
not just in tooling and robotics, but also massive expansions of their facilities like at the electric boat site.
Yes. They are betting billions, literally billions, on building future throughput capacity. They did cite one key metric, which was encouraging. They said sequence critical material deliveries were up 40% over the last 2 years.
Okay, 40%.
Which suggests that these remediation efforts, while slow, are starting to kind of heal those supply chain wounds. And on the flagship program, the first Columbia-class sub, construction is apparently hitting roughly 60% completion by the end of this year.
60%.
Hitting that mark is good. It reduces some long-term uncertainty, but it also puts maximum pressure on execution over the next few quarters to keep that momentum going.
Okay, so outside of marine, the other defense segments had, let's say, mixed revenue growth, but really phenomenal booking activity. Combat systems, tanks, land vehicles saw pretty modest revenue growth, only 1.8%.
Right.
But the orders were huge, $4.4 billion, giving them a 2.0 times book-to-bill.
Yeah, that 2.0x book-to-bill is striking. It signals massive forward demand. And this seems tied mainly to international combat vehicles, especially demand coming out of Europe right now. Plus, significant work on ordnance and missile subcomponents. Given the current geopolitical climate, management sounds pretty confident that their established international production sites position them well for accelerating revenue growth here, as they start converting that big backlog.
And then the technologies segment was the only group that actually saw revenue dip slightly, down 1.6% year over year. But again, like combat, the bookings looked stellar. A high book-to-bill of 1.8 times in the quarter and running at 1.3 times for the year so far.
Exactly. So that backlog conversion should position them for much better revenue growth down the line. Their focus there is more on high-tech mission system side. They're leveraging strategic investments in things like cyber, AI, advanced computing.
Yeah.
And when they talk about zero trust environments, they mean building these highly secure defense-grade networks.
Right.
These investments are really in specialized, potentially higher margin digital capabilities. They're designed to drive profitability once that backlog gets fully funded and starts converting into actual revenue streams.
Okay, so picture emerging is a clear, high-margin winner in aerospace that's basically funding these huge, necessary long-term investments in the defense industrial base where margins are currently light.
Oh, it's a good summary.
The question then for investors is about visibility, right? What are the key risks still out there? And what did the updated guidance tell us about how GD sees things moving forward?
Well, management did provide updated guidance. They raised the annual EPS forecast slightly, but cautiously, to between $15.30 and $15.35.
Okay, a slight raise.
And revenue projected around $52 billion with that overall 10.3% margin we mentioned. Now, that caution is entirely understandable. The main uncertainty hanging over this guidance is external political friction, specifically the ongoing threat of a government shutdown.
Ah, yes, the perpetual elephant in the room for defense contractors.
Absolutely. Management noted it's just extremely difficult to forecast the impact, especially on the shorter cycle parts of their business and, crucially, on cash flow. If contracting personnel get sent home, critical payment approvals stall. It gums up the works.
Right.
And we actually saw a tangible sign of their contingency planning this quarter. To manage that liquidity risk, in case the government temporarily stops paying its bills, they confirmed they re-entered the commercial paper market shortly after Q3 closed.
Interesting. So borrowing short-term just in case.
Exactly. It's a protective step, just ensuring they have access to cash if the political drama disrupts payments from D.C. They were quite clear. The risk gets substantially worse if a shutdown is protracted, if it spills into the next fiscal year. That could potentially cause certain defense business lines to literally run out of funding authorization, which then raises a big operational question. Can they keep up the pace of investment and maintain that high cash conversion if political gridlock disrupts the payment cycle?
Yeah, that's a big unknown. Okay, so setting aside the political drama for a moment, what are the purely operational catalysts that could move the stock from here? They got this enormous record backlog, $109.9 billion.
Right. So the catalyst map really focuses purely on sustained execution now. First, just keeping that Gulfstream delivery cadence going strong. The G700 and G800 ramp needs to continue smoothly for that high margin stability.
Okay.
Second, simply converting that colossal backlog into actual revenue and cash flow, particularly in those more complex defense segments like marine and combat.
Makes sense.
And third, hitting those supply chain normalization checkpoints in marine systems. If they can demonstrate progress in moving those margins significantly above the current 7% level, even just getting consistently to 8% or 9%, that would likely trigger a massive re-rating of how the market values the entire defense component of their business.
Got it. So it really comes down to proving they can execute on these massive, complex programs more profitably.
Precisely.
And just before we move on, it's worth noting management's strategy update, or lack thereof, perhaps. They confirmed they're basically doubling down on their core platforms, defense and Gulfstream. Focuses on program improvements, execution. They explicitly dismissed pursuing things like supersonic business jets right now. Seems they're sticking to their knitting, focusing where they see durable, decade-long growth.
Yeah, seems like a pragmatic approach given the scale of the opportunities already in their backlog.
Okay, and that brings us to our closing segment. This is not financial advice, just the usual reminder. We are absolutely not recommending you buy, sell, or hold any security. This is purely for educational and maybe entertainment purposes. But this is where we pitch an outrageous but plausible trade idea based purely on the specific things we picked up from this earnings call.
All right, so let's frame the investment thesis first. Right now, the market seems to be rewarding GD for that clean, high-margin aerospace story. That success is probably, largely priced into the stock already. But the biggest opportunity for potentially outsized returns, we think, might actually be hidden in the deferred margin potential deep within marine systems. Management was crystal clear. Stabilizing that supply chain is the one key to pushing those stubbornly low 7% margins back up towards industry averages. And that's an explicit multi-year operational project they're heavily invested in.
Right. So the outrageous but plausible trade idea.
We're pitching long-dated, out-of-the-money call options on GD common stock, thinking an expiration maybe 12 to 18 months out.
Okay, calls 12, 18 months out. What's the rationale?
Well, this trade is basically a highly leveraged bet. It's purely on the success of management delivering on that internal operating leverage narrative we just discussed. It assumes that all those substantial investments they talked about, the new tooling, the robotics, those massive facility expansions at Electric Boat, that these efforts will succeed in fixing the supply chain issues enough to yield noticeable margin expansion in marine systems. Maybe in late 2026, perhaps early 2027.
So you're betting on the fix happening within that time frame.
Exactly. And if that margin leap happens underpinned by the guaranteed revenue from that massive, non-cancelable Columbia and Virginia-class submarine backlog, it should trigger a significant re-rating of the entire defense valuation component of GD's business. that could push the stock well past current expectations. It's essentially a pure bet on operational execution, specifically on fixing the guts of the defense industrial base.
Interesting. A leverage bet on turning around the marine segment margins.
That's the idea.
All right. That brings us to the end of our deep dive into General Dynamics Q3 2025 earnings. Key takeaways. A strong overall beat, definitely driven by that impressive aerospace scale. An enormous durable backlog across all the defense segments, providing great visibility, but tempered, as always, by that persistent supply chain friction, especially in marine, and the constant background noise of political risk and shutdown threats.
Yeah, and maybe we'll leave you with this provocative thought to mull over. The company is investing so heavily in long-term capacity, building huge new facilities, ramping up training for these gigantic multi-decade programs like the Columbia-class subs. They're even converting apparently part of an old regional mall site in Connecticut into an engineering and training hub.
A mall.
Yeah. So when you see a major defense contractor making such permanent physical infrastructure changes, converting old commercial real estate into specialized defense facilities, what does that signal? What does that kind of permanent shift tell us about the perceived lasting nature of this defense industrial demand, maybe compared to the more temporary nature of political fiction or budget squabbles? Something to think about.
That is interesting. What stands out to you from this call? Let us know. Thanks for diving deep with us on Talk Takers. We'll see you next time.